Welcome everybody to our next webinar here at JFD Brokers, and I say welcome also in the name of JFD Brokers. Today at the 9th of November, um, 2017. Wow. Yeah, 7 o'clock p.m. as usual for that kind of webinars, that kind of topics. Today's topic is DAX gap close strategy. I think something you have heard in a lot of textbooks, articles all around, that we have gaps, and there's a myth that gaps are closed always, or not nearly always. And that we maybe can trade that kind of approach profitable. So we will have a close look to that kind of approach with DAX gap close. And funny enough, I have to tell you a side story here, and that is that another colleague working totally different company, working at God Mode, has published an article more or less exactly the same topic, same conclusions. It's really nice. We haven't talked about that topic, so we even don't know each other personally. But funny enough, it is as it is. So he wrote an article, and I do the webinar here. But same conclusions, which is interesting, and maybe supports that basic analysis here. As always, the webinar is recorded, and you can already upload, or better to say download, the slides of today's webinar via the GoToWebinar control panel. And you will find the recordings of the webinar on the JFD YouTube channel. Just press exactly that JFD YouTube channel at Google, and you will be immediately directed to that YouTube channel. If you want to get in touch with me personally, that's absolutely no problem. Just use the email address mentioned on the first slide here. I know I have a very complicated last name, so it's s.friedrichowski@jfdbrokers.com. I mentioned that especially because if you want to have those slides or Excel sheets I will show later, then just send me an email, and I will make sure that you will get them. Good. As always, before really starting, I have to show this one slide because we talk about trading strategies, and you will indeed see that today we have a very simple but maybe very convincing strategy. But finally, you trade always on your own when you do your personal trading, and therefore I have to show this slide as always. So, having done this, let's go into the topics of today. As the title already tells you, we talk about gaps. So we have to define exactly what a gap should be, is, and how a gap will be closed. Maybe you would say, hey, that's easy. There's only one definition. No, there are a couple of definitions for gaps. There's something like a common sense, but the best is I define exactly the way how I call a gap, and then we can do the analysis exactly along that line. So no misunderstanding finally, because we really do it mathematically in the final end, and therefore we need strict rules as always when talking about those kind of analysis. Since we will develop something on DAX, the so-called DAX Xetra, which means the standard trading times. German time would be 9 o'clock a.m. Until 5:30 p.m. And therefore we need exactly those prices. Since I get a lot of questions of how to get price histories, I will show it here once again. For that example. And the good thing as well is that, especially at JFD Brokers, you have a CFD instrument, which is exactly the Xetra DAX. That means the trading will stop at 5:30, and if, for example, a stop loss would be hit later, it will not be executed. It only depends on the next morning at 9 o'clock. And if still the DAX is at your stop loss level, then the stop loss will be hit, of course, but finally you don't care about the night. On the other hand, you have that gap risk if you would trade overnight. But that is something we will not do. So we don't need those kind of aspects, but I just want to mention, and I will show you later how to find that instrument on the JFD MT4 platform. It's a good instrument because it still has exactly 1 point spread. So it's good to have those good trading conditions there. Before really going into the topic of gap close, I want to share with you another DAX analysis. And as you know me more and more during the last couple of months, if I talk about a DAX analysis, I don't talk about chart analysis. It's just pure mathematically, but we can draw some conclusions which are really amazing. I haven't thought about that before simply done those kind of analysis. And it's more the question, when is the moment of growth of the DAX? So when in time is really, or what portions really make the overall growth? Because we know, everybody knows that on a long time scale, the DAX goes simply north. But let's have a look when the growth of the DAX will really happen. It's amazing, the result. But you will see in a minute. Then finally, of course, we go into the DAX gap close analysis and try to derive a real trading setup out of that. And more or less astonishing once again, we will have a profitable strategy, but it will be totally different than you may expect. So it's really nice that we have, a few maybe remarkable things exactly today. So let's start with the definition of a gap and the gap close. You see here I have an example. It's indeed the DAX, but I simply without time scale and no y-axis here because we don't need it for the definition of a gap. So we have some candles, and of course there is one obvious gap exactly in the middle of the picture, and that obvious gap is exactly here. And I wrote down the definition of gap up and gap down. So in this case here in the middle of my example, we have a gap up. And the definition is simply that the open of the new candle, which is exactly here at the position of my mouse cursor here, that open is above the previous candle high. And that is meant with writing T-1. So that means the previous candle simply. So, and of course, here we have a gap. So that open is above the previous high, and therefore we have a gap up. The definition of how that a gap is closed is simply, in this case, it's not closed because the price during the next day here never went down to that high. So that gap is still open and it's not closed. Which might be obvious here in this case that we have here a gap up and an additional gap up here is maybe not that straightforward always. Let's do a quick exercise here. And I first will mention my question here. How many gaps are exactly in this chart? And I know the time is short, and I will not talk minutes just around that chart. So you have a few seconds to maybe count the gaps within the chart. And finally, you may be surprised with the final answer. But so we have a couple of obvious gaps here, like you saw the one before. And there might be gaps you don't think about. So the in practice, so in the real practice, it's much easier than looking to a historical candle chart, because at the moment when you at 9 o'clock and you look to the chart, then the gap might be much more obvious than within this chart here. But anyhow, so answer comes now. I don't see a remark yesterday. When I have done the same webinar in German. So I got answers like three gaps, and another one voted for 6 gaps, but the final answer is 11. And still, I'm not sure whether I counted those gaps really right. So we have, and I marked all the gaps with an arrow here. And a lot of them might not be that obvious. So in this case, I marked already 11 gaps. Let's start with the first one, just to see how difficult it may be. Oh, there's somebody already saying, I count 16. Okay, I'm not sure. I'm even still not sure. Later we do it mathematically in Excel, then there's no question. But let's start here, that you see why it's that difficult. Let's start with the first one here. The open of the candle is exactly here. And that open is below the previous low of that candle. So we have a gap here. Okay, the gap is closed. No question. And you see there are other gaps which might not be that obvious. For example, this one here. So my mouse cursor is now here. Put it a little bit aside. We have the same situation here. Previous candle, the open of the candle is here, far below. So once again, it's not that obvious that we have a gap here. It doesn't look like at first view. And still there are a lot of other gaps which you only find on the second view. And but once again, in reality, it's much more easy if we trade finally those gaps, because it's a more it's a real market opening. It's much easier than afterwards. And even the last one here, and this is more or less exactly on the edge. No, sorry, it's not on the edge. So the open of that candle is here. So you see that we have a gap even for the last one as well. So really a lot of gaps. I marked 11, and maybe one of you is even more right than me here with 16. Anyhow, in this case, I marked those which are filled with that special color here. So 3 which are not filled. 3 gaps are not filled, and you see them here. The percentage of that 1/3, about 1/3, is still open. You will later see is more or less exactly what is the overall average, which is astonishing as well. But anyhow, so that's the definition of gaps and gap close. So let's go further with historical data we need in order to develop such a strategy. And my data source here, I use at Finance Yahoo. And let me quickly share this with you. So then it becomes much more obvious how I always get my historical data. And so that is Finance Yahoo. And then we go to Markets, World Indices, and it's quite easy to get those data. Within that list, we find the DAX under DAXI, which is a symbol here at Yahoo Finance. And then we go for historical data. Then we can select the time period we want to have. I go for maximum. And then I can download, apply, and then I can download those data. And now I have for more or less 20 years the data. How does it go further? Because you will see if you do the same exercise that unfortunately Yahoo has done something which is not that good. But I simply want to show you what I mean here. So those are the data. And first we delete a few columns here, which because adjusted close and something like that volume, we don't care. But now you see what's wrong with the data. Not really wrong, but you see sometimes here a null. And maybe that's weekends, or maybe that's days without trading. But finally, when we want to deal with those data, we have to get rid of those. And just show you how easy you can manage in order to get them right. We simply mark them, then we sort the data, for example, along the close data, and then we have all this null at the very end. We can delete them, and then we sort them back with the date, and then we have all those rows deleted. But now you see another thing which is not good here. In the beginning of the data, you see that open equals high equals low equals close. So that's wrong, definitely wrong. So we have to delete those as well. And just to have it easier, I simply do high minus low and get this 0 here. And then I can scroll down to where the data are correct. And that's exactly here. And in order to start with a new year, I delete all those data here. Oops. And delete, and then we have it. So that's a preparation just to get the data right. Quickly done. It's a little bit sorting, and then you finally get them right, all the data. And we have now data since 1994, so a little bit more than 20 years. That's a lot of data we can deal with, and we can do our kind of analysis. So how to start? What's first? I mentioned that within the scope of the DAX close, DAX gap analysis, I did something else, and which is really astonishing, at least with the conclusions we can draw from that. And as I mentioned already, DAX goes mainly north. That is no secret. That's true for nearly every index. But the question is the main growth overnight or at daytime? So think about, since we have the Xetra values, is it growth during the day, so between 9 and 5:30, or is it maybe during the night, so just always the opening, which is already giving us the overall growth within the DAX? So that's a question. But now we do the analysis, and then we can look what's the real result of that. So how to do that? I only will introduce a little bit of how and what I have done here. So first, I built up a number, simply close minus open, and do the percentage calculation. So think about trading. that would mean that it's a growth or the percentage change during a day. So from open to close. So in the first row here, that's a 1% growth within that day, starting at the open, ending at the close. Then I did something else, and that analysis is now, let's look for the growth, so the percentage change from close of previous day to open of today. So that is the growth or the percentage change overnight without really trading the Xetra DAX, and the main volume is really traded during those hours I mentioned from 9 to 5:30. But that is a change, a percentage change during the night or during the non-trading hours. So that's the difference, open minus close previous, and do it in percent. And finally, what I've done is here simply the close to close calculation. So from one close to the next, which is more or less the DAX itself. But anyhow, so the percentage grows from close to close. And what I did now, I have added those values up like an equity, like a real account, just the percentage changes. And now the astonishing result. What you have here is in three colors. In blue, the close to open. So that is adding up all percentage changes during the day. It's like a trade we do from the open at 9 to the end of the day at 5:30. And if we just would want to think about like real trading, it would be always a long trade, and that would be your equity. It's a zero line, more or less. So during 20 years, just adding up all percentage changes during daytime, during the main trading hours of the Xetra DAX, has not gained anything. It's a zero line. And in between 2003, we have a deep dip south to the south. That's astonishing. That within the normal trading hours, we have on that long run not a single growth in the DAX, no gain. The overall gain of the DAX, which is more or less the yellow line here, stems from the night. Because here the red line is adding up all the percentage changes from close of previous day to open of next day. That's interesting. That's really astonishing. And honestly, I would have not expected such a result. We have more or less three periods here. One starting at my chart here and then going up to 2000. Steep increase. All the gains have been developed at night. Then the next more or less 10 years, it's more or less flat. And since 2010, or a little bit before, we have the straight line here once again. So during the last 16 years, the growth of the DAX has been at night. Who would have expected exactly that result? I don't have an explanation, and I only share that kind of information here with you, not already telling you, hey, that's a great strategy, but maybe we can use exactly that for another strategy to be developed, and that's not the topic of today. The simple answer right now, or drawing the conclusion here, would be open a trade at the close, so close to a little bit before 5:30, open a long trade, and you close the trade at the next morning at 9. That's all you have to do. That would be really simple. But at least what I can tell you, your equity line looks like this red line. That's astonishing. Um, so it's really amazing to have that kind of result, that all the growth of the DAX, all the gains comes from the night session, without more or less volume. So anyhow, so that's the first conclusion. It has nothing to do with gaps. On the other hand, what we have here is the origin of the gap. We will now talk again. So anyhow, so that's the first result. Astonishing enough. Now let's come into the gaps. The DAX gap close trading strategy. How do we start? We have a couple of questions we want to answer, and those questions will help us to develop that kind of strategy. First hand, we want to know, are gaps closed in majority, or are they still open? If we would see, hey, only a few percent of gaps are closed, then it might not be a good idea to close exactly to trade exactly that kind of gap. But let's see what the answer is. How many gaps are closed and how many gaps are left open, at least during the first day? If we know how many gaps are closed, then we can ask ourselves, hey, can we trade that kind of gap closing? And of course, we want to know, is it profitable, yes or no? We will see that is not that promising, but we can do a little bit more, and that will help us to get finally that kind of trading strategy. Trading the gap close normally means, let me go to that slide here back. Let me always do it here with the extreme negative result in here at the, okay, let's even go here, then we have only one example. So in the middle here, we have that gap up. Trading the gap close normally would mean that at the open of that candle here in the middle, we have a gap up, then we would open a short trade, expecting that gap to be closed. So it would be a short trade, expectation south, and that should be our gap close strategy. Gap up, go for a short trade. Gap down, go for a long trade, always expecting the gap to be closed. So that's what we have in mind. Now let's go into the figures. So as you know, we have already done a little bit here. We have the DAX values, open, high, low, close. Then we have done our analysis on my previous Excel sheet, still here within that Excel sheet as well. But now let's go, oops, that's too far. Here, how I have done this analysis simply in Excel. So first question is, I have to translate my formulas on my slide just into Excel, which is not a big deal, but I just want to show it here a little bit. So we want to ask, do we have a gap up? And if the answer is yes, I want to have a 1 here and otherwise a 0. And what we have to do is we have to compare the open with the high of the previous candle. So that is exactly that condition. And so that's the definition of a gap up. And whenever we have a gap up, then we get a 1 in that column. Gap down is more or less the same, but now we have to compare the open with the low of the previous candle. And if our open is below the low of the previous candle, then once again, I get a 1 here. Let's check a little bit here. In this case, we have a gap down. Let me mark it, then it's a little bit easier to see. And you see, hey, the open is about 10 points below the low of the previous candle, and therefore we get a 1 here within that column. Whenever we have a gap, so therefore we have the condition, do we have a gap up? Then I simply calculate in numbers, in percentage, here that gap up so that we know how big is a gap, and same we do for gap downs. Finally, what we do here is we ask ourselves, hey, is that gap closed? And in order to close the gap, we need two conditions. One, we need a gap. So therefore, we have the condition, do we have a gap? And second question, is that gap closed? If yes, then we get a 1 here as well. And the same for gap downs. Now the interesting result. You see that I have summed up all the gap downs and the gap up closed and the gap down closed, and it's more or less the same number. And you see here, there's still a German word that is the percentage gap up closed. That means untitled, but anyhow. So in rough numbers, 2/3 of all the gaps are always closed. So that's already promising that we know that most of the gaps are closed. Now let's think of a trade. Let me go back to my slide here with my picture. So once again, in this case, in the middle here, at the open of that candle, we would open a short trade, expecting the gap to be closed. Now we have a problem. And the simple problem is that we don't know where to set a stop loss. So we have a trade without stop loss. Just expecting the gap to be closed, that's all we can do. Virtually, or not even virtually, even in practice, we could say, okay, we place a stop loss, I don't know, 1% above that limit here, above the entry for that short trade. But then still within my Excel sheet and doing the analysis on a D1 chart, finally, I don't know what event happens first. The gap close, maybe, not in this case, because that gap is not closed, or hitting the stop loss. Okay, therefore, we cannot really say we place a stop loss here, because then we would have to go to smaller time frames in order to know what event, stop loss or take profit is first. By the way, take profit is the high of the previous candle. So, okay, then let's think about a trade without stop loss. I know that's dangerous, but in order to do a quick calculation, and later you will see that kind of calculation will help us a lot. We assume we do a trade without stop loss. You know me more and more that that's not what I really do, but in this case, just for consideration, for calculations, we will do it. So then we have the following situation. We open the trade here, and if during the day the gap is not closed, then that trade would end at the final close of the day. And that's something we can calculate. In this case, if the gap would be closed, we would gain exactly the gap size as our profit. And in this case, the downside, or it would be a minus trade, because that trade would finally end here at that close, which is then, because it's a short trade, a real bigger minus trade. Let's start with that kind of calculation and look where we get with that. So I have done exactly that. The profits, I have added all the profits here, or not in this case, I have first put them into the Excel sheet. If a gap is closed, then you see we get a positive result here, the 0.11%. And for example, here we have an example, the gap is not closed, and we close the trade at the close of that candle, and that trade would be closed with minus 1.22%. And that for gap ups, that for gap downs, and then adding up all the stuff. That's all we can do. And then we can look for the equity once again. in the same way we did it before. That's a chart you know already. And here we are. Here's the result of our gap close strategy without for looking for real trades. It would be trades without stop loss. We would gain if the gap is closed exactly the gap size. That's our profit. And if the gap is not closed, then the trade would be ended, would be closed at 5:30. What do we have? Although we know that the majority of gaps is closed, we have equities which go straight to the south. Both gap up and gap downs. They behave more or less the same. The main difference is here at the final end. Here, the gap down close would work because here the equity goes north. So the conclusion is, although we know that the majority of gaps is closed, we cannot trade them profitable, at least not without a stop loss. We have a hit rate of 64%, but our result is negative. But now think about it. What looks extremely negative here, can we change that to a positive result? If you think a little bit more, then you have the immediate answer. Yes, of course, we can. Let me go back to my picture. What if we simply change the trade direction? In this case, we have a gap up per definition. We realize exactly our gap up at the moment of the open of that day. We have a gap up, and since we now reverse our thinking, we say we do not speculate on a gap close. No, we want to have the price going north. If we have a gap up, we trade long. So we open a long trade, which indeed within that example here is a perfect example. And you see trade would finally end in a big profit. Now we can set a stop loss perfectly. Let's set our stop loss at the gap, meaning it's in this case the previous high of that candle. So we can place our stop loss on that level here, on the high of the previous candle. We open the trade at the open of the day. And if the stop loss is not hit during the day, we close the trade when Xetra DAX is closed, which is 5:30. So that's all. Now we have a complete picture of a strategy because we have a good stop loss. And the stop loss is simply being set or established by the chart itself, which is perfect because you may already realize what we have here compared to other strategies we discussed during the last months is a strategy without any parameter. We have nothing to optimize, at least up to now. We don't have an EMA period, which we turn from 10 to 20 to 200. We don't have a percentage stop loss value. So we have a stop loss, but the stop loss is already being set by the chart itself. So it's inherent. That's perfect. That's really perfect to have no degrees of freedom, to have a strategy without any parameter. Still, you can introduce a lot of parameters here additionally, and you may enhance the results. But it's good to know that already without any parameter, we have something which should be profitable. You may listen exactly, I changed to should. We have to check something. We are not at the final end in our strategy development. Simple reason. What we have done up to now, we have not incorporated any costs. So just mirroring those lines is nice and is exactly right if we would not have any costs of trading, no commissions, no spreads. And as you may know, the costs of trading are always something which have to be calculated here as well. Because if we don't do it, we might be misleaded. Because finally, if we would trade it, the costs can take can beat can get all our profits, so can compensate all our profits. So we have to take those profits, those costs in mind, and we have to calculate them. So therefore, what we do next is let's try to translate that result in real trades. And real trades in my language means we want to trade them in the risk unit R. And as you know, how is it done? Let me go back to my picture. Risk trading in risk unit R means if you want to place here an order, like here, and let's assume the gap has a size here of 30 points. If you want to risk 60 euros for that trade, then at JFD you would open the trade with 2 lots. And you simply translate the gap size and your risk value, 60 euros, into your lot size calculation. And if you do analysis like this, it's the best you can do is simply to always assign the risk as 1R. Then finally everybody can do the calculation by its own. Maybe you want to trade with 1R equals 50 euro, or maybe 1R equals 2,000 euro. It's only a matter of lot size, but your risk is always fixed, and you can finally translate it to your position size of your trade. But trading in R is the best you can do for those kind of investigations, and therefore we will do it exactly like this. So the gap size is now our risk, and that equals 1R. If we would gain here, and that would be an example here, that finally the percentage profit we have here is exactly double as big as the gap size, then we would gain 2 R's. In euros, it simply depends on how many euros you assign to 1 R. I have done this here within the Excel sheet. And so it simply goes further here, further down the road. And I have calculated everything, including the risk value of the gap size, which is 1R. Then I have put additionally 2 things. Every trade ends, and then I have to subtract a one-time spread from my profit. So if I have 80 points profit in DAX points, then I assume here 1.5 DAX points. And the reason for using 1.5 is not JFD is offering 1 point. It's 0.5 is simply they stand for the commission we have to pay as well. So it's a rough estimate to incorporate the commission here as well. So that's a good estimate. So we use a spread of 1.5. And I put something else here. And what I put else is we have finally trades which have we trade extremely small gaps. We have had examples like this on my introductional slide. Let's have a look here. That we have trades with an extremely small gap. Let me find an example, hopefully fast enough, that we have a very small gap size. They are, in this case, all the examples are not that. Maybe this one here. So we have, from time to time, we have the situation that we have extremely small gaps, maybe only 1 point. If 1 point later equals 1 R, it would mean if you trade with a risk of 100 euro, then you would trade 100 lot. So that's dangerous and even complicate even placing those orders. So what I have put additionally into the calculation is whenever I have 2 small gaps, I assume values for the risk calculation of 0.1%. I will show what happens if I go to 0 with that later. So we get here now our equity. Equity for that kind of strategy, you remember, we know originally we went south, and now we go north. But the good thing is what we have here as our final. Oh, sorry, that is going north with that, and now we have it here in risk calculation in units of R. And you see that we finally, over the last 20 years, we would profit approximately 1,000 Rs with that kind of strategies. If you want to have euro values, you have to multiply it simply by a number which you risk per trade. If that would be 100 euro, then that would multiply to 100,000 euro. You see, that strategy would have run extremely well until 2010, and even then, still we have a growth. The downside is a little bit here, exactly during the last 1.5 year, the strategy went south, so we would not have profits. But anyhow, remember how easy, how simple that strategy is. We don't have any parameter. We don't have an EMA value we have to care and to optimize and maybe over-optimize. We don't have any parameter at all. So it's simply driven by the price value itself. That's all. Let me show you what happens when we, if I would not have this minimum stop loss value or size of the gaps, then you would have an equity like this, which really looks strange, isn't it? And you may wonder because of those vertical lines here, but it's more or less something mathematically. That happens because the gap size is maybe 0.01%, and then we would trade with that small gap size, and we would have an enormous trading volume. And then we would, of course, gain a lot, but that's not. That's more. Let's call it a mathematical artifact here. Therefore, it's good to have that kind of minimum value. Otherwise, we would not be able to trade it directly. So we have a good strategy, very simple to do, and all we have to do is we look for, and let me show it here directly in MT4, how we would trade that kind of strategy, for example. And you may trade that CFD on Xetra DAX directly. You can still trade it with a standard DAX index, or you can trade it even with the FDAX. But you would use those hours, 9 o'clock German time until 5:30 German time to close the trade, and that's all. And here at JFD we have this German 30 cash etc. And we can open a chart here, and then you directly see how it works. Let me have that same graph than before, and then you can see that's exactly those pictures we have on my slides as well. And you see, if you look now, the price is fixed. It will not change during the next 12 hours or even 13 hours. There's no change. And tomorrow morning, it will open. You will directly see at 9 o'clock where and whether we have a gap. It's more or less, we might have a gap down. We don't have a gap up, more or less for sure, tomorrow morning, but we might have a gap down, and we would trade that gap down further to the south. That's the definition of the strategy we have developed during the last 1 hour. Then we would trade to the south. We have our stop loss is the low of that candle, so I can give it already a number. So the stop loss would be at 13,174.25. You can see the number always on the right corner, the right low corner here on the screen. I cannot go with my mouse cursor there because then the number would vanish. But so it's easy to have that number. I know already there's a potential stop loss for tomorrow short trade. If we have a gap down, then we would open that short trade, and that's all we have to do. So we have an impressive equity line without any extra parameter, no turning point, nothing. It's a pure strategy without any additional parameter, which is astonishing that it works that well. But it is as it is. So that's fine. That means for us, we have a new strategy. We can trade. Let me make my summary here. And don't forget the other observation first. We don't use it right now for a strategy. That strategy would be even more simple. The downside would be that we have no stop loss. That would be opening a trade a few minutes before the DAX closes, and then we would open a long trade, and that's all. And we would do it always, every day, and that only because we have made the observation that all the growth of the last 20-year DAX growth stems from the nights and not from the days, which is always astonishing that we have that kind of result. So let me see how we can turn that into an additional strategy. Will be a topic maybe in a few weeks or months. But we have another strategy now. We know that 2/3 of all gaps are closed. Sounds promising in order to trade the gap close. But it turns out that without any stop loss, we cannot trade it profitably, even if we have that edge, that probability advantage of 2/3, which is enormous. But finally, our trades went south, or our equity went south. But since we have that kind of observation, that kind of conclusion, we know exactly what we can do. And that is reverse that kind of approach. And that means if we have a gap up, then we open a long trade. And if we have a gap down, we open a short trade, which is exactly vice versa to that gap close idea. Now we have a stop loss because the stop loss is the gap itself. And we can trade a normal trade. With a stop loss, we have no take profit. We simply have a time stop, and the time stop is 5:30. That's all. We have a parameter-free strategy, which is astonishing that we can turn that already into a profitable one. And that's good to know. And we have a simple way how to calculate the profits. and you have seen that all in those Excel sheets. If you have interest in those sheets, I will share those sheets with you as well. Just send me an email here to s.friedrichowski@jfdbrokers.com, and I will make sure that you get those sheets as well, the slides and the Excel sheet. So both, and then you can do your own calculation. Maybe for other underlyings, I have not done this exercise up to now. But anyhow, so hopefully you enjoyed the webinar. So it's time to say have a good night. Maybe not directly, but I wish you a good evening. Bye bye. See you next.